Good afternoon, everyone. This is one of those days that I'm just kind of ready for the day to be over. Is everybody kind of there with me? Yeah. It's just, Dr. Barnes sits every Monday, Wednesday, Friday at 1:30. That's how we feel. So yeah, you can be snarky. That's okay. I've earned it. I've earned it. No, I'm just kind of tired today, and I think maybe I just partied a little too hard the weekend. Who knows? Although I don't know if what you would call what I do partying. It's more along the lines of not getting that extra hour of sleep in the morning. That's kind of my definition of going wild nowadays. All right. I'm just going to ramble if I don't get started. So let me go ahead and remind everyone that we are week 7. Um, so we need to really start thinking about what the group presentations are going to look like at the end of the semester. I currently have 0 groups scheduled. I currently have 0 requests to be in a group. I currently have 0 idea of who's going to be presenting with one another at the end of the semester and what the projects are. I would like to get those resolved. So at the very least, I'd like to know what the groups are going to look like by the end of this week. So please start thinking about that. Start talking to people close to you. You want to be in a group? You want to be? Oh, let's be in a group together. All right. And then let me know who those people are. Just as a reminder, we have 4 groups. So it's going to be 2 groups of 6 and 2 groups of 5, given the size of the class. So if you don't have a full group, that's fine. If you do have a full group, that's fine too. I'll work it out one way or the other. If you don't have any preference, I'll put you in a group at random. That's kind of the drill. All right, today we're going to talk about internal control, which you think that given we're talking about internal control, I'd be really excited, but I don't know, maybe it's just my crazy weekend that I had. And specifically, we're going to talk about internal controls over financial reporting. So let's go ahead and get into that. We're going to look at some practical examples in today's class period to kind of reinforce what we already know. So recall this from chapter 6. This is our COSO objectives and our COSO cube and stuff that we've talked about before. And we've already established that of these 3 objectives, the most important of these is going to be reliability of financial reporting. And just as a reference as to why that's the case, I know we've said it multiple times already, but keep in mind, the objective of the auditor is to form an opinion on the financial statements as a whole, okay? Whether the financial statements are free from material misstatement. What is the product of financial reporting? That's the financial statements. So it makes sense that the controls of our financial reporting are going to be an area of focus for us. Where does this come from? Well, it comes from our good old friend Sarbanes-Oxley Act of 2002, specifically Section 404, which I think is actually kind of aptly named. If you ever looked at some of the old computer systems, whenever they ran into an error trying to find some place on the internet that didn't exist, it was called a 404 error. So it just kind of makes me chuckle that we call this we call this Section 404 because nobody really knows what it does. But Section 404 of the Sarbanes-Oxley Act basically says the managers of publicly traded companies must issue a report that accepts responsibility for establishing and maintaining adequate internal controls over financial reporting. They also need to assess whether ICOFR is effective as of the end of the fiscal year. So this is an important concept. Basically, they're saying, Sarbanes-Oxley Act said, if you are a publicly traded company of a specific size, as a manager, you have to issue a report that says you're responsible for basically the design, implementation, and maintenance of internal controls over financial reporting at your organization. And you also have to assess whether these controls in this specific area are operating effectively. Now, that's not true for controls in other areas, and it's not true for companies of other types, not like non-publicly traded companies. This is a specific requirement of a specific company type for a specific type of control. So it's important to keep in mind that this is really, really critical, but this is not relevant directly to what we're talking about today because we are, after all, talking about the auditors. Now, it's indirectly relevant because what do the auditors have responsibility for? And the answer to that is they are required to audit management's assessment of the effectiveness of internal controls over financial reporting. So management says these controls work. Auditor may say, yes, we agree with that, or no, I don't think so. One of the two. And PCAOB Auditing Standard 2201 states the auditor must conduct the audits of financial statements and internal controls over financial reporting in an integrated way because each audit provides the auditor of information relevant to the evaluation of the results of the other. So let's go ahead and talk about the implications of what that means, all right? First of all, we as auditors are required for certain companies to test internal controls over financial reporting. As a requirement of testing for most publicly traded companies. I say public trading companies a certain size. We talked about that threshold last week. We talked about cost was not subject to the requirements under this rule, but most companies are. It's $100 million of revenues, I believe, is the current requirement, annual revenues. If they're under that requirement, the auditor has to test these internal controls and make it or render an opinion over the effectiveness of internal controls. We're going to talk about the opinion types shortly, but it's very similar to the opinions we talked about with respect to financial statements. This is a different and separate report. However, the last paragraph basically says that we have to conduct these two tests, the audit of financial statements and the audit of internal control, in an integrated manner, which is a really weird concept. It sounds like they were saying simultaneously, which that's part of it, okay? These do occur at the same time. They occur over the period of the audit, but the integration is a little bit more than that. The idea being is that information that we're going to learn during the financial statement audit is going to be relevant to testing of internal controls and vice versa. So we need to consider how we can coordinate the audit of both internal controls and financial statements so that we have the most effective opinion, or most efficient and effective opinion that can be rendered. All right. Let's go ahead and discuss something we discussed last week and reiterate some points, all right? So internal control deficiency is defined at a very basic level. Anytime there's a problem, we call that a control deficiency. So when we identify a problem in internal controls, we say the control is deficient. It's a control deficiency. Now, this is basically our category for any type of issue. We're going to render some more categories out here in just a second, but recall that when we talk about the nature of controls, controls can be deficient in one of two ways. There can be a deficiency in the design of controls. Either the controls are not present, or the controls are present, but they were not designed the way they should be to address a particular problem. So design and deficiency is our first consideration. There's a deficiency in design, not design and deficiency. Deficiency in design, and then we have deficiency in operation. This is where the control is present, but it's being ignored, or it's not operating effectively. So those are the two considerations that auditors have to keep in mind. Now, there's another degree of complexity that we're going to add to this. We said that control deficiency is kind of our baseline, but if a deficiency becomes severe enough, we can upgrade them, okay? It's a little bit like when you hear about a tropical storm, it becomes more severe, they upgrade it to a hurricane or downgrade it back to a tropical storm when it weakens, okay? We have kind of those type of events we talk about with respect to an audit and an audit of internal controls over financial reporting. If we believe that it's significant enough to represent a problem in the future, then we're going to call this a significant deficiency. Now, significant deficiency is basically saying that the problem in controls is significant, but not material. Significant, but not material, which is really weird because it's like, what's the difference between those two terms, Dr. Barnes? And my answer to that is like I answer all questions in accounting. That depends, right? It's not going to be significant enough to result in a material misstatement, but if left unchecked, it probably could over a period of time. My example for this is kind of the basic example I use. So did anybody have a car back when they were in high school? Okay, so I had a car that was granted by my parents. Back when I was a kid, when I was like 8 to 12 years old, we had this big, massive blue van. It was not like a minivan. It was like one of those boxy old 1970s vans, which is really cool because it had like carpet inside and a table and back where the kids could relax and just take a nap and stuff like that. Really great for traveling across the country. But I got granted that when I turned 16, I could drive that van around. It was my van, but I also had to take care of it. I was not a responsible 16-year-old. I was not a good, responsible 16-year-old. I had a part-time job so I could pay for gas, and that van took a lot of gas, let me tell you. But you know what else vans need? They need regular care and maintenance, all right? Such as oil changes. You have to change the oil. Want to guess how many times I changed the oil in my van? Give you a hint, it's less than one. It's less than one. What happens when you don't change the oil in the van? The oil that kind of deteriorates and kind of disappears, just kind of it won't work anymore. So my van was a significant deficiency. Driving it without oil, it was fine in the short term, but if I continued to do it, it was going to become a problem, and it did become a problem. My van basically stopped working. I said, I guess I should have paid attention to that check engine light. Yes. So that's kind of example of significant deficiency. In the short term, not a problem. In the long term, will likely become a problem. The most significant or severe issue is going to be what we call a material weakness. This is a weakness in controls that is significant enough, or severe enough, I should say, severe enough to that's likely going to result in a material misstatement in the financial statements. All right. So if we say that we've got a material weakness, that's basically the biggest problem, the most severe problem we can have controls. And of course, I can't just have one side of the slides and not have the other side of the slides. So here's Dr. Eisen. We actually buy some cloth to make some curtains, and actually never with cloth, that's a material weakness. Yeah. You know, I can see Dr. Eisen telling the joke and have his little chuckles. Yeah, like that. All right. Anyway, that's what I would imagine he'd say if it's with material weakness. You know, what does Dr. Eisen know about auditing anyway? All right. So, judging the significance of a control deficiency, management and the auditor must consider two dimensions of the control deficiency. What are those two dimensions? Likelihood and magnitude. What's the difference? Well, I'm glad you asked, because I've got this nice, neat graph that we can actually talk about it. We start out judging the likelihood of the deficiency, the likelihood that it's going to result in a control issue, or a problem, okay? Likelihood that it's going to result in a problem. So you'll notice down here that we say that if it's a remote possibility that something's going to happen, we don't even consider it to be one of these three categories. It's nothing. It's none of the above. It's not a control issue, all right? It has to be at least reasonably possible or probable of occurrence for us to even consider it to be a deficiency of any type. Easy way to think about this, okay? What if I talked about the possibility of a meteor hitting the Earth and extinguishing all life on the planet? Is that a pretty severe event? Okay, so why are we not building a giant meteor-proof shield over the planet to try to stop meteors from hitting the planet? I would say if it's severe enough to end all life on Earth, we probably should address this particular problem, right? What is the likelihood of that happening? To my best estimates, it happens like once every 65 million years, okay? That was the last time that a big meteor actually extinguished most of the life on Earth, and we rebuilt from that, okay? So the dinosaurs are not so lucky. But the likelihood of occurrence is so remote that we don't even consider the material or the significance of the impact. We say, well, it's unlikely to happen, so we're not going to worry about it. All right. So if it's not likely to happen, we basically say it's nothing. If it's at least reasonably possible, that's when we start making our judgment. So if it's not material or significant, that's when we just say it's a control deficiency. All right. It's a control deficiency. If it's material, or sorry, it's not material, but at least significant, that's significant deficiency. That's where we say that it's going to become a problem in the future, not necessarily a problem right now. And then if it's a material problem, material magnitude, that's a material weakness. There's a few things to note really quickly about this that I want to make clear. First of all, we're going to talk about the different levels of management that we report to about these different deficiencies, okay? So if there's no deficiency, we don't have to report to anybody. If it's control deficiency, we tell management, hey, you've got a problem with your internal controls. Not a big problem, but a problem. If it's a significant deficiency, we go tell management, and then we go report to the audit committee and say, yeah, this could be a problem in the future. You better keep an eye on it. So the audit committee gets to know about it. And then if it's a material weakness, that's where we go tell management, we go tell the audit committee, and then everyone else. We actually report it in the audit report over internal controls, okay? So the audit report over internal controls, we actually talk about the material weakness. So everybody knows about it. So those are kind of the severity levels of who we report to. Also, I want to make a note here. The book does a really, really poor job of going into in-depth details on these. We'll actually have some homework over this. We have to look at some examples, and they only give you two choices. They give you a choice of significant deficiency and a material weakness. It's either one of those two, which kind of is a little bit of a letdown because you want to know the different severity of different types of controls. In the book, it's going to give you examples that you're going to have to justify between those two examples. On the exam, I will ask you all four different possibilities. There's no deficiency, there's only a control deficiency, a significant deficiency, and a material weakness. The good news is my examples will be very, very clear. And you'll be able to judge on these criteria that we're setting down here. The book just doesn't have any of these examples, which I think is a shortcoming of this particular chapter. All right. So in assist management, the SEC issued guidance for evaluating and assessing a COFR. This evaluation process has 4 steps. Identify financial reporting risks and related controls. Consider which locations to include in the evaluation. Evaluate evidence about the effectiveness of a COFR. Or 3 steps. I said 4. I don't know why I read that as 4. Bizarre. Okay. I could tell you that I looked back and it said FOUR, but 3 steps. Okay. I can count now that there's only 3 steps. Man, it sucks getting older. All right. Let's repeat that. I'm going to go back and edit this. This evaluation process has 3 steps. 3, definitely not 4. Okay. Identify financial reporting risk and related controls. Consider which locations include the evaluation and evaluate evidence about the operating effectiveness of ICOFR. Let's go ahead and talk about a little bit of detail about the steps in performing an audit of internal controls or financial reporting. I want to tell you right now that the next 4 slides that I'm about to go into, I always ask a question about details on these 4 slides, usually multiple questions. I always have poor performance rates on the questions of these slides. I think people see these slides and say, that's just a jumble of details. So what I'm going to tell you right now is, 1, take these next 4 slides very seriously. 2, take detailed notes on these next 4 slides because I'm going to add additional information on to what I'm about to tell you. So, while the audit of ICOFR and the audit of financial statements have different objectives, the auditor must plan and perform the audit to achieve the objectives of both audits as an integrated audit. So the idea being is that as we're planning our financial statement audit, we are also planning the steps in the audit of internal controls over financial reporting. So what are some things that we need to note about specifically within this planning process? Well, first of all, we need to understand what are the steps of planning. So, okay, this is slide number 1, by the way, of those 4 slides I'm talking about. You're going to notice that it's going to change slightly because the stuff on the right is going to stay the same, but the stuff on the left is going to change. Planning, the auditor considers the following activities: the role of risk assessment and the risk of fraud. Scaling the audit. So scaling the audit is basically saying if different levels of audit are more important and prominent than others, then we need to focus on those areas. So auditing of the corporate headquarters probably going to be very important given the scope of the audit. Auditing of maybe a store location, not so much, because those are not going to have a big impact on financial reporting. Then using the work of others. This is an area where we could utilize the work of the internal audit function and rely upon their reporting simply because they're going to have more insight on the day-to-day activities related to internal controls in this area. Okay, next. Identify the controls to test. And when we talk about controls, one of the very first things we need to think about, and something we've not considered, is what is the role of entity level controls? Now, we know from the COSO cube that controls hit multiple different levels within the organization. But let me just ask you a very, very basic question. Of the nature of controls that are most likely to affect financial reporting, would you assume that a location control, like the control at a store, like we'll say a McDonald's store, is going to be more likely to affect financial reporting, or the controls for the entity as a whole? Yeah, the entity as a whole controls by far, okay? One example of this is an example of the entity controls. So here's a major control that we would consider an entity level control, and that's the period end financial reporting process. So you know those financial statements that you're required to prepare under generally accepted accounting principles? What is the purpose of preparing those financial statements? So just to say, well, we want to put 100 pages out of material that nobody is ever going to read comprehensively because that's too much detail. You guys have seen those 10Ks. You're just kind of like, okay, that's way too much. I'm never going to read all of that. But why do they produce that information? That is a demand piece of information. That's for stakeholders outside the organization who want to have transparency in financial reporting. It is effectively a control itself. It's saying, we want to make sure that you're doing your job properly, management, so you're going to have to report on your operations for the year. That is the period in a financial reporting process, and it's an entity level control. Another entity level control identified by the book is the control environment in place at the organization. I know what you're thinking. You're probably saying, Dr. Barnes, that's not right. That's a component of internal control. And you're right, it is. It's a first component of the COSO framework. It is so important that we consider that a control in and of itself, a standalone control that represents the entire tone of the organization. If they don't have good controls in the organization, then it's going to be bad for the rest of the organization moving downward. Something that actually relates to the code or the control environment are some other controls in this area. So has anybody ever heard of a code of conduct in an organization? You ever heard that term? That would be viewed as an entity level control, as well as a whistleblower hotline. For reporting fraud anonymously. Many organizations implemented those after the financial scandals of the 2000s, early 2000s. Those are all examples of the types of entity level controls that would affect financial reporting. Basically, what we're trying to determine is what protocols are in place to make sure the entire organization as a whole is headed in the proper financial direction. Okay, so that's all entity level controls. By the way, I just gave you 4 entity level controls. This is not on the slide, but you will be responsible for knowing all 4. So make sure you made a note of all of those. All right. Next, identify significant accounts disclosures and the relevant assertions. This is actually pretty straightforward because we've talked about that as basically as we've talked about the nature of internal controls. So we need to understand what are the significant areas of risk within the organization and what are the assertions that we identify associated with those risks. Okay, very, very easy. If we're talking about internal or we're talking about inventory, talking about what internal controls are related to inventory, we are probably very concerned about the existence of inventory, both the existence of being overstated for financial reporting purposes and understated for theft purposes. There's possible directions in both of those. So we want to make sure that we have controls that address both those risks and understand the assertions that are related to both of those categories of risks. We want to understand the likely sources of misstatement. Within an organization, we're talking about financial reporting. This is definitely going to be a concern with respect to proper financial reporting. Fraudulent financial reporting is a big risk in many organizations, especially if they have outside pressures to over-report. So we want to make sure we understand the controls that are over financial reporting. We also want to make sure we understand the supplemental controls that kind of affect things that could affect reporting as a whole, whether that be from intentional or unintentional misstatement. All right. Then we want to select the controls to test. So we need to understand what controls are relevant in this area and how do we test those. All right, moving down. So we're talking about some other things that were around here. So this is the fourth one. So evaluating the design and testing the operating effectiveness controls, the scope of testing. What are some things that we need to consider within the scope of testing? Well, there are a few really important ones, okay? So what are the types of audit procedures that we're going to perform? Now, at a very basic level, when I ask this question, you should already know what are the tests that we can perform as test of controls. So inspection records and documents, observation, inquiry, re-performance, walkthroughs. But what's going to be the most appropriate test for a given situation, and do we gain enough assurance from those tests? What do we know about observation and inquiry with respect to reliability of the evidence that's provided? It's very low, okay? So we may have to supplement those with other types of tests to actually corroborate them. Extent, we need to know the number of tests that we need to perform as well as sample sizes. We haven't talked about sampling yet. Does everybody remember sampling from Stat 220, the concept of that? We're going to talk about that at a basic level on Wednesday. I will tell you right now, I'm not a statistician. I will never claim to be a statistician. I'm not that crazy, all right? But it's important to understand statistical concepts, probably most importantly because they still get used to some degree in CPA firms with public accounting, okay? But we need to understand the underpinnings behind that, all right? Then timing, we've already talked about those, interim versus year end. When are we going to do the majority of our testing and whether or not it's appropriate to do testing over controls in this area. Some of our testing may require year-end testing, particularly if it relates to the year-end financial reporting for testing the controls for the current period financial reporting process. That's going to be something that we can't really get a lot of testing in early because the year-end reporting doesn't occur until year-end. So it's important to make notes of that. So I think I said 4 slides. Maybe more than that, so sorry. So those 4 slides, and there's going to be a few more a little bit later on that I'm going to point out. So those 4 slides are a really big focus, but I want to take a quick break so we can kind of take a look at some examples of testing in this area. So the nature, timing, extent of procedures in this area. So this is Exhibit 7-3 in the book. If you don't have that open, you can actually go to Brightspace, and I've actually got this on Brightspace as a handout that you can look at. So basically, we got Bill Boyd, who's the manager for Emmons and Shin. He's doing some information testing related to cash received in the bank lockbox. So you hear the bank lockbox. What is the bank lockbox? Okay, is it like what the DSP uses for concessions, like big steel box where they hold the cash in? Is that the type of lockbox we're talking about? No, when we talk about a bank lockbox in the system, this is a system the bank has set up so that transactions get directly sent to the bank rather than to our client. Why would we want to do something like that? Well, something we're going to find out when we get to the revenue process is one of our big concerns with respect to completeness of cash receipts is that they get taken before we actually get to put them in the bank. How do you bypass that? You say, send them directly to the bank, okay? That way they don't get stolen. So they're using a bank lockbox system. They receives from the bank an electronic file listing cash received from the customers. So customers send it directly to the bank. The IT system applies the cash received in the lockbox to individual customer accounts. Then any cash received in the lockbox and not applied to the customer's customer's account is listed in an exception report called the unapplied cash exception report. So there's basically 3 controls in place here. 2 of these controls are automated controls. The final one basically says the system was not able to identify where this cash receipt is supposed to go. So we're going to let you investigate it afterwards. Is everybody following the process right now? So customer sends in cash to the bank. Bank says, here's the cash. The IT system says, all right, this cash sheet matches this invoice, cancel it out. This cash sheet matches this invoice, cancel it out, or these invoices. But if they got a cash receipt, they can't apply it to a particular item. They say, we don't know where this is supposed to go, investigate. So we've got somebody who's supposed to be the review for the investigate point. So Bill is actually going to test this. He's actually going to look at this and say, what is the process for this control? All right. So he's going to actually test to make sure that we'll test the manual control and see what the process is for this and whether or not the control itself is effective. So to determine whether there's a listing of non-matching cache items on the exception report, he's going to perform test controls to ensure the operating effectiveness, the control, the review, and the follow-up of the daily unapplied cache exception report. So he's basically saying, I want to make sure that if an exception occurs, that whoever's responsible for following up that exception is doing their job properly. So first step, inquiry of inquiry entity personnel about the procedures in place that all unapplied items are resolved, the time frame which the resolution takes place, unapplied items are handled within the system. And so Bill talks to people and he's just kind of like, okay, I have a good understanding of what happens here. I have a good understanding. So he did an inquiry step. And you'll notice up here, he's satisfied with the results of that particular test. So are we good? We're not good. Why can't we actually move on from here? Why can't we just say, okay, that inquiry was sufficient. We now understand the process. We can move on with our lives, go test other controls, go eat other cheeseburgers, whatever it might be. Why can't we just say that we're good with this? What do we know about inquiry or the reliability of inquiry tests? Low reliability, okay? You could talk to somebody and they could lie about it. So what do we have to do? We have to corroborate those tests. Fortunately, Bill's no dummy. He's actually reperforming the control. So he goes and looks at 25 random daily unapplied cache or exception reports from the period from January to September. And he basically says, I'm going to reperform the tasks that this person did who reviewed the exception reports. I'm going to do exactly what they did. And if I come up with the exact same results, then I'm happy. And guess what what happened with Bill? He basically did it and everything looked good. It looks like they followed the protocols exactly as they identified during the inquiry and was happy with the results. So we're done, right? There's a problem here. You'll notice there's no information, okay? It says something that says follow-up tests, okay? So some information here. Part 3 says follow-up test. Bill's already done the testing, okay? He did inquiry, he did reperformance. That should be enough, right? What period did he do the testing for? January through September, okay? The year end is December. So we've still got a few months that are at the period end. So Bill, being a conscientious auditor, says, all right, since the tests were performed at interim date, he's going to talk to some people and he's going to test a few more items just to make sure that everything looks good. All right. So this is a really, really good example. I really like this example from the book of how to walk through an example of a test of iCoffer for this particular scenario. And this is an example, it's a very specific scenario, but this is the general approach that we would use for all of these. We'd say, what is the nature of the control? How are we going to test the control? How are we going to interpret the results? So if you didn't follow this one, make sure you do this one. This is why I put it on there. I think this is a pretty basic one, but it does give a lot of information of detail with respect to how we test the controls. All right, moving back. All right, so we got another slide here, and this is something that we need to move on. So I said that we had 4 slides before, so we have 4 slides before this, which make sure you know those 4 slides. We had an interrupting slide, and now we've got a 5th slide that I want to throw up here, okay? So as discussed earlier, severity of control deficiency depends on 2 factors: the possibility the company's controls will prevent and detect any misstatements, that's likelihood, the amount of potential misstatement resulting from the control deficiency, magnitude, okay? So this is a problem. It's like saying that this is the problem that we're trying to evaluate here when we try to judge the magnitude of the control deficiency. We're trying to say, all right, what is the likelihood that something will fall through our control system and result in a problem? We've identified a situation. What's the likelihood an issue will occur? If we determine that it's at least reasonably possible an issue will take place, then that's where we move on to magnitude. Now, keep in mind, this is not necessarily a function of the controls themselves, okay? The fact that we have a control deficiency does not necessarily imply that there's going to be a high likelihood. If you've got a control deficiency in a control that never gets used ever, has never had a transaction flow through that particular control, then we probably could say there's a remote possibility of misstatement because it's never had a transaction flow through it, all right? Even if the control itself is deficient, we don't care. But if we say that it's at least reasonably possible a transaction would flow through the control, then we need to assess what is the possible misstatement, the potential misstatement resulting from the control deficiency, which is the magnitude. All right. So that's where we're going to move on to another scenario. Okay. So let's go ahead and look at a couple scenarios in the slides. We need to actually justify, we're going to say we got some control deficiencies in here. Specifically, there are severe control deficiencies, either significant or material weakness, significant deficiency or material weakness. Now, as I said before, the book is really, it has this fixation on whether it's significant deficiency or control weakness or material weakness. On the exam, you will need to be able to consider not only the possibility that it could be one of those two, but also the possibility of just a control deficiency or none of the above. It's not a deficiency at all. But for this particular scenario, we're going to keep it simple. We're going to say it's one of those two. So let's just go ahead and read through this. Murray Company processes a significant number of routine and intercompany transactions on a monthly basis. Individual intercompany transactions are not material and primarily relate to the balance sheet activity. For example, cash transfers between business units and finance normal operations. A formal management policy requires monthly reconciliations of intercompany accounts and confirmation balances between business units. However, there is no process in place to ensure performance of these procedures. As a result, detailed reconciliations of intercompany accounts are not performed on a timely basis. Management does perform monthly procedures to investigate selected large dollar intercompany account differences. In addition, management prepares a detailed monthly variance analysis of operating expenses to assess their reasonableness. What do you guys think? Is this going to be a significant deficiency or a material weakness? I'll give you a hint. It's one of those two. Significant deficiency. What are some of the important terms that actually imply that it's a significant deficiency and not a material weakness? The transactions themselves are not material. That's a big one. Okay. So they're not material. There's also some additional information in the second paragraph. The control itself is defective, but it looks like they do have redundant management review of the process. That's not to say the control should not be fixed. It's just to say that the likelihood of a material misstatement is going to be remote because management would pick up on something that's really severe, really material. All right. So this is pretty easy, simple example of a significant deficiency. All right. Well, that was fun. I think everybody had a great time with that. So let's do another one. Ragunan Company processes a significant number of intercompany transactions on a monthly basis. Well, it looks like we got two companies doing that. Intercompany transactions relate to a wide range of activities, including transfers of inventory with intercompany profit between business units, allocation of research development cost of unit, and corporate charges. Intercompany transactions are frequently material. A formal management policy requires monthly reconciliation of intercompany accounts and confirmation between business units. However, there's no process in place to ensure these procedures are performed on a consistent basis. As a result, reconciliations of intercompany accounts are not performed on a timely basis, and differences in intercompany accounts are frequent and significant. Management does not perform any alternative controls to investigate significant intercompany account differences. What do you guys think? Significant deficiency or material weakness? This is material weakness for the opposite reasons we just discussed. Okay, transactions are material, and there's no redundant controls to try to prevent these transactions from being overstated. They say that they occur pretty significantly and pretty frequently, which is certainly problematic. As an auditor, I'd be kind of like, yikes. Okay, that's where I'd be in this particular company. So yeah, those are very simple examples, by the way, but we're going to look at some more of these as we go through the homework. Again, considering both likelihood and magnitude. When we think about that, we already know likelihood exists because it says that it's at least a significant deficiency, if not a material weakness. So magnitude was kind of our big concern there, and we can identify some particular areas of emphasis with respect to that. All right. So real quick, before we move on to kind of our final slide in the area and start talking about what the results are of the testing, let's talk about a possibility. So we're an auditor. We walk into the test of internal controls or financial reporting. We're at an interim date. And so we'll say it's like July and the reporting date is December. And we look at a control and the control itself is just garbage. It's likely to result in a material misstatement. We're saying, hey, client, you're going to have a material weakness. Hate to tell you, bud, but it's just kind of rough. All right. The client says, oh, is there anything we can do about it? And we say, nope, you're just in trouble. You're just in trouble. Does that seem fair? Doesn't seem fair to me. It's if the client is willing to fix the problem, shouldn't we cut him some slack? Yeah. So we do have a protocol for that. It's something called remediation. It's a process of correcting a material weakness in internal controls over financial reporting. Now, remediation sounds great, but it comes with a lot of ifs. All right. It comes with a lot of ifs. If a material weakness is corrected before the as of date, okay, So we say the as of date, that's basically going to be the audit report date, is going to be kind of our last point in time. There needs to be sufficient before time, or say as of, sorry, by say as of date, I'm talking about something else. So as of date, my apologies, balance sheet date is as of date. There must be sufficient time for both management and the auditor to test the operating effectiveness of control. So to recall, when we actually have internal controls related to financial reporting, both management and the auditor have to assess the effectiveness. That's a requirement under Sarbanes-Oxley 404. So if they correct the problem, then management actually has to test the control again to make sure it's operating effectively. Then auditors have to go through and do the same process to check and make sure the control is operating effectively. So to remediate the problem, management has to fix it, to test it to make sure it's working correctly, and the auditor's still going to have time at the end to make sure it's fixing properly. Now, the reason the as of date was saying is that the control itself has to be fixed before year end. The testing can occur before the issuance of the financial statements. Now, I want to make it very clear that remediation does not restrict the fact that their control at one point in time was not operating effectively. But we can state that the problem was fixed before year end, and so the control was operating effectively as of year end. Because keep in mind, if the control was operating ineffectively at some point in time during the year, there's a possibility that a material misstatement occurred during that period. We can correct that because we can force them to restate the financials, but there's still the possibility of that issue occurring during the period. We're just trying to say if you correct it before year end, then we can avoid the ugly issue of this having to be a material weakness as of year end. Now, important to note, all three criteria, okay? Fix the control, management test the control, auditor test the control, okay? Those three things have to happen. If those do not happen, an adverse opinion is going to be issued. So basically we're saying if we don't have time for full remediation to occur, then we can't state the control is now operating effectively. Which is, by the way, a spoiler because we're going to be talking about different types of opinions that are rendered in different scenarios. All right. After auditing the effectiveness of the entity's internal control, and the auditor issues a qualified opinion if the entity's internal control is designed and operating effectively in all material respects. Okay. So basically, we go through our testing and controls. We evaluate the identified control deficiencies. If we believe the controls are perfect, there's no control deficiencies whatsoever, that's an easy one. We can basically say the controls are great. We're going to issue a clean opinion. What do we say, though, if we have any kinds of problems? Well, the answer is it depends on the nature of the problems. So let's go ahead and break down this diagram right here. Let's go what we're going into with this, okay? So the very easy one that we need to break down is the stuff on the left, okay? A report based on the type of deficiency, all right? If it's a control deficiency, control deficiencies are considered to be very, very small. We tell management to fix the problem, but they're generally not going to be big enough to result in a material misstatement. So if it's just control deficiencies, then we don't have to change our opinion. We can say unqualified opinion. If we're talking about significant deficiencies, that's where things get a little bit confusing. Significant deficiencies, you're probably like, well, that's going to be a problem, right? I said, yes, it will be a problem probably for the future. But if we're talking about controls right now at this point in time, it's not a problem. Remember my van that I was driving, okay? My van with no oil in it that eventually broke down. When I was driving it, it was just fine, okay? So it's not a problem right now, but I do need to correct that problem in the future. Otherwise, I'm going to have a van that doesn't work anymore, okay? So significant deficiencies, still an unqualified opinion. But again, we do report to management and to the audit committee that these significant deficiencies exist. The only type of opinion change for a deficiency type is going to be for material weakness. Because by definition, a material weakness is large enough that significant enough to result in a material misstatement or likely to result in a material misstatement. If that's the case, we issue an adverse opinion. You will notice there's no middle ground there, okay? There's no qualified opinion for internal controls report, financial reporting. This is not the same audit as the audit opinions for the financial statements. This is a different series of opinions, a different series of reports. So we either have an unqualified opinion or an adverse opinion. We do have a different scenario though, because remember we talked about the possibility that we could not do our jobs back when we talked about this in chapter 1. What was that called? It's called a scope limitation. Everybody remember the concept of scope limitation? The same could be held true, and it doesn't happen often, but it could happen with respect to testing of internal controls. If we do think that there's a substantial scope limitation, then we can disclaim our opinion just like we can for an audit. We could also potentially withdraw from the engagement because we say we were not able to do our job. There's no reason for us to be here. But this is rare that happens. The only time really a disclaimer opinion happens is if there's a substantial scope limitation over the testing of internal controls over financial reporting. So 3 types of opinions. It's a small effect, or control deficiency or significant deficiency. We can say unqualified opinion. If it's a material weakness, adverse opinion. If it's a substantial scope limitation, disclaimer opinion. That's basically what you need to know for the breakdown. All right. So what are some other reporting issues we need to talk about? So first of all, we need to talk about subsequent events, which we're going to talk about subsequent events at a very general level. This should be something you remember from financial reporting. I think 303 talked about subsequent events. Subsequent events in this context is talking about subsequent events related to controls. What happens if we say the controls are working properly as of December 31st, 2025? And then for some reason, they completely and totally change their control system and the control itself starts operating like garbage. Do we have a responsibility for that as auditors? We would say, well, no, because Dr. Barnes, that relates to the period in the future, not the period under audit. All right. But what do you know about subsequent events for financial reporting? Subsequent events are significant enough to attract the interest of stakeholders, even if they don't necessarily relate to the period under audit or the period under review. If there's a control change of incredible significance that's likely to result in material weakness, then we do have a responsibility to report on that. So we do have a responsibility to consider subsequent events. So period after the as of date, but before the issuance of the audit report. All right. What if the auditor decides to refer the report of other auditors? The good news is we don't really need to talk about that right now because we're going to go into more detail on that in Chapter 18. Chapter 18, the policy will be exactly the same. It really depends on the level of responsibility the auditor takes. If the auditor takes full responsibility for another auditor, then we're going to say there's no change necessary. If the auditor says we're not going to take responsibility, then we have to change the language. But I don't think you need to worry too much about that now because we'll get into a lot more detail about that after spring break. All right. So what if management's report is incomplete or improperly presented? So remember, not only do we issue a report as an auditor, but management has to issue their own report. What if they issue a report that's not complete or if it's not correct? That's basically where we say the controls themselves are either working great or whatever our opinion is the controls, but we're also going to add some additional language to our report to disclaim an opinion on the, or sorry, to modify the, we're going to modify the ICOFR report to actually not disclaim an opinion, my apologies. We're going to modify our ICOFR report to note the inconsistency in management's presentation. Keep in mind the management screwing up the report does not affect the nature of controls. We don't say there's an adverse opinion then, okay? All we're going to say is management did not do their job properly with respect to reporting, but the controls themselves are great, or the controls themselves are whatever our opinion is. Next, what if management gives you a good report, but then they throw in a whole bunch of information that's redundant or unnecessary? So management gives you the reports and then they start talking about, and we just like to say that we think our controls are fabulous. Nobody has better controls than we do. And people really say that we have the best controls. But they throw information like that in. Yeah, that's not information that we're auditing. That's not information that we are rendering an opinion on. If it's something that we have not tested and it's in the report and it's not relevant to our opinion, we disclaim an opinion on that additional information. Not on the controls as a whole, but just on the additional information that management provides within their report. So if they throw a whole bunch of meaningless drivel out and irrelevant, we're going to identify that and say, you know, this stuff they were talking about that's not supposed to be part of the report, but is, yeah, we don't care about that. We didn't test, we didn't audit any of that. We don't have an opinion on any of that. Then what about reporting on a remedial material weakness at an interim date? So what does this mean? What do we say about remediation? Remediation has to occur before the as of date, or before the remediation. Remediation has to occur with sufficient time as of date of testing. So let's say that the client is trying to fix the controls, but they run out of time and they can't actually test the controls. The auditor can't test the controls by the time the financial statements are issued. What do we say the opinion is in that situation? An adverse opinion? Okay. The client then, before the end of the first quarter, they fix the control problem. Okay, they fix the control. We as the auditors test it, the client tests it. Is it fair for them to continue to holding to that that adverse opinion for the entire year, even though they fixed the problem? Probably not. So this is where we're going to jump in, and we're going to say, as the auditors say, hey, they had a problem, they fixed the problem. We are now satisfied the control is operating properly. That's what we're talking about, remediating a material weakness at interim dates. Okay. And that's where we're going to issue something called an interim opinion. We'll basically say, as of this date, the control is now operating properly. So that's our new opinion. Last thing to talk about. Auditor must communicate in writing of management and all committee all significant deficiencies and all material weaknesses identified during the audit. This is according to PCAOB Auditing Standard 2201. This communication should be made prior to the issuance of the audit report on ICOFR. So just as a reminder, if it's a control deficiency, we just tell management about it. Okay. Significant deficiency, we're going to tell management, the audit committee. If it's a material weakness, management, audit committee, and everyone else. Okay. All parties who have access to the audit report. One really quick notation about that, though, that's a little bit confusing is, if it's a control deficiency, doesn't it just get reported to management? And the answer is yes. However, the audit committee does have a vested interest in making sure management is aware of all control deficiencies that are reported. So even though we don't tell the audit committee what those control deficiencies are, we're going to tell the audit committee when such a communication has been made. So auditors should communicate all control deficiencies that were identified during the audit, regardless of the size, anything that's likely to result in a misstatement, anything that's likely to result in an issue. Management knows about that. The audit committee does not have a list of all those control deficiencies, but they need to be notified when we tell management about those control deficiencies and tell them when such a communication has been made. Okay. So even though audit committee does not know about what the control deficiencies are, they do know that management is responsible for taking care of those, and we as an auditor have told them what all those issues are. So that's my responsibility. And that does it. That's chapter 7 in a nutshell. We'll do chapters 8 and 9 on Wednesday. I will see you all then.